Hello, everyone. Welcome to the Hurley Investments. What is a put option? My name is Kevin Hurley. My pleasure to go over a quick short video with you on options, and I hope this is going to be helpful for you. Today we've chosen the put option because our put option is that option derivative that's going to derive itself most of the time from the stock price it's associated with. You can use an ETF or an index. There are other equities that use options, but I'm going to keep it simple and stick with stock ownership. This particular option, probably one of the most important options that's out there, or the most important in my book, is its purpose is to protect the value of stock ownership from drops. This is the insurance on your stock. I absolutely love it. Protect your stock ownership from that loss, those big drops. What is it? What's its thought process behind it? It's similar to purchasing car insurance to protect a car if it gets totaled. Stocks get totaled all the time. They lose 20, 30, 40, 50% of their value, and that can happen 4 times a year at earnings events. This is that option that protects you from a stock crash, just like car insurance would protect you from a car crash. Its contract gives that purchaser, you're going to buy it, the right to sell your stock at a predetermined price for a predetermined period of time. You're going to set up how long you want to buy that insurance and at what price you want to protect that stock ownership at. The puts increase in value as the stock price goes down. In other words, it's a bearish position to own. It makes money as stock movement is bearish. Pretty neat. Just to give you a thought, what if your stock dropped from $100 down to $50 and you had bought this put option at $100? You could still sell your stock up at $100 and buy 2 more shares at $50. Just think about that. How cool would it be to have protection? So if your stock lost half its value, you could sell it at twice as what it's worth, double your share count on your stock ownership. Again, it's often used as stock ownership to protect it. If you had 500 shares of a stock, remember one options contract only covers 100 shares. So if you have 500 shares of stock, you would have to buy 5 contracts to protect those shares. This put option, when you buy it, it's usually called a long put. If you buy it in conjunction with stock ownership, it's usually called a protective put. But how does it work? Let's wrap your mind around it. Let's say you spent a ton of money on this Ferrari. Obviously, it's a beautiful car, right? You're going to buy an insurance contract that's going to insure the value of this asset. I'm sure this car probably cost, what, $115,000, $120,000. So you're going to pay a premium to an insurance company that says, hey, you know, for the next 6 months, I want to protect this car at $120,000. It's going to last for that 6-month period of time. If you get in a wreck, you total your car, instead of being out or still owing the $120,000, your insurance pays to repair it, to replace it, or it just pays off your loan, right? So let's say your car example is Apple stock. See how we have the Apple stock that shows up on the door there on that Ferrari? 500 shares right now, the stock trading around $225. If you bought 500 shares, you'd have Apple stock in the value of $112,500. So let's protect that. Let's protect that value of stock ownership. Let's buy the right to sell our stock at $225. We're going to pay a premium right now. That'd be about $9. So for about 3% of the value of your stock ownership, you can protect that for about 2 months. Right now, again, it's about 3.25%. Usually it's about 4%, 4.5% of the value of the stock to protect it for a 3-month period of time. If the stock price falls, we're still going to have the right to sell our stock way up at $225, where it's currently trading. Pretty neat that you get to pick the price you're going to sell your stock at. How does this work? Well, you need a brokerage account at TD Ameritrade, Schwab, E-Trade. E-Trade would be my favorite out of all these. Just a platform that lets you buy the stock and it's going to give you some margin. Margin is available in all types of accounts. You have portfolio margin, you have stock margin, you have options margin, but it's just the right to have an obligation or a right, and that you have money in your account to fulfill it. You're going to select the list of dates that option will expire. This is called an options chain. I'm going to show you one here in a quick minute. But the strike price is that price you want to sell your stock at. This is different than the option price, which is where you pay to own the option contract. Just remember that there's a bid and an ask. I'm going to show you that here in a quick minute to understand it, but here's our options chain. Up in the upper left-hand corner around our red box, we have Apple. Tells you what option chain you're looking at. We're going to look at the puts on the right-hand side. You'll see the red circle around puts, where we're going to buy the right to sell our stock at a predetermined price for a predetermined period of time. How far out we go is defined by what month or what options expiration chain you want. We have marked November and January. It's the beginning of October. We want to protect ourselves maybe through the October, most volatile month in the stock market. And if we protect ourselves out to November, the monthly options change. The third Friday of each month, options expire on a monthly basis. That'll also get us through Apple's earnings event. I would choose the November. My red arrow there, I'm going to protect us out 7-8 weeks. I'm going to make sure we get through October, which is our most volatile month, and the Apple earnings, giving a couple months to follow a trend after the earnings event. Right now, it's about 45 days out there in time. Strike prices are that middle column. I would choose, since Apple's right now trading at pretty close to 225, I'd protect it where it's at. I'd protect it at the money. I would choose a 225 strike price where I can protect some profits I have in it, and where I'll have the right to sell my stock at $225 for the next 45 days. Right now, it's going to cost me $9.40. I'm going to give myself the right for the next 45 days and huge volatility and huge movement on the stock for an earnings event that I can protect my profits in my stock and sell to 225. When you buy protection or buy an option, you always do it in the ask column. If you were to sell an option, you would do it in the bid. That's called the spread, where the money makers can make a little bit of money, difference between the buying and the selling. So that gives them an incentive to make sure that those contracts, and they can put people together to make sure your options get bought and sold in a timely manner. Let's see what else here. Option prices, you can see where they last traded at. That gives you an idea if you're into scalping, or if that term means anything to you. If you want to try to get a little better price, here I was going to buy my option at 940. That's the last price it sold at. I'm probably going to get filled at 940. If I tried to cheapen it and try to only pay 925, chances are I'm not going to get that position filled. All righty. $9.40 to protect my Apple stock per share for 100 shares. One contract is 100 shares. For me, this is going to cost me $940 to protect 500 shares, or actually 100 shares, to protect $22,500 worth of stock ownership. Again, about 4%, a little bit less than 4%. With the big moves that go through Apple, that might be a really wise position to be in. It's considered at the money, just meaning it's pretty close to where the price is currently trading at. If I wanted to go out of the money and be cheaper, if I only wanted to protect $215 or $220, it's going to be cheaper because I'm going to have some risk now between where I can sell my stock and where it's currently trading. In the money, if I think it's really going to fall down, I can protect it at a higher price. But you're going to pay a higher premium to protect it at a higher price than it's currently trading at. Just have to keep that in mind when you're going to choose what type of option you want to use. Buying and selling. ask equals that you're going to buy. So if you're going to buy an option, eventually you're going to sell it. You buy at the ask column, you sell in the bid column. If you're going to buy that long put, the right to sell your stock, again, I'd open it up and I'd be buying it at $9.45 or $9.40. If the stock goes down, I'm going to hopefully sell it for more than I bought it for. But this is a simple opportunity that for the next 45 days, I'm going to protect my stock ownership with the right to sell it at $225. You could say, hey, I can't afford to own stock ownership in Apple, but you could short a put. Now remember that S in short stands for selling. So if you're going to sell a put, you're going to look at the bid column. You would close it by buying it back at the ask column. If you're going to sell a short put, it obligates you to buy the stock at a certain price for a certain period of time. If you think Apple stock's going to go up, you could sell a put at maybe $220. You would get, if I can take my highlighter, you would get $7.10. That's collecting $710 for the contract. So if Apple goes up, guess what? You're going to keep that $7.10 or that $710 for one contract. Just remember, obviously, this is the long put example, but long puts are associated with short puts. You have to make sure you understand the difference between the two. Guys, the long put, what an awesome position it is that gives you the ability to protect stock ownership. I love using that long put in conjunction with stock ownership as an insurance contract. This is what will make you profitable in our next market crash. Hope you enjoyed the short video here on the long put. We're just real world investing knowledge from real investors trying to help real people make some real money. Guys, please like us on YouTube, subscribe if you can, click on that bell so every time we get a new video, you'll have some more information at your hands to help you do the best you can with your trading. Appreciate you being here. Look forward to seeing you on the next video.